In this mini lecture, we discuss corporate governance. Corporate governance are a set of rules and procedures that are all focused on achieving accountability. And accountability is an issue for businesses because they are using other people's money, not their own, and because they're dealing with other people's employment and time and supplies. And so accountability for all of the resources that are drawn on from all of the different stakeholders within our community is a requirement. When coupled with our discussion about ethics, we start to get a full sense of what's the requirement for responsible, sustainable businesses in our community. Let's put a definition on corporate governance. We should understand corporate governance as a system of mechanisms that provide assurance to owners that management can be held accountable for their actions. Keeping in mind that the owners of business rarely these days actually work in the business or have any control at all over what goes on. And so the intermediaries and the intermediary mechanisms have to try and align the interests of owners with managers. And so these mechanisms help us to oversee the actions and the outcomes of management. And they put around management a series of rules and procedures which are defined as appropriate for the environment, but they're not supposed to hamper management. Management, after all, has to make the decisions and operate the business, but they are designed to make management accountable to owners and to other stakeholders in our community. So the definition focuses on mechanisms that are within the business. When we're talking about the actions and the outcomes of management, these are mechanisms within the business. And examples of those mechanisms within the business will be the board of directors and audit committees. Audit committees are a subcommittee of the board. When we start talking about external corporate governance, we're referring to mechanisms which are imposed in the interests of external stakeholders, and an excellent example of these are the ASX listing rules. The ASX listing rules are really quite onerous, and the biggest ASX companies also have to subscribe to the principles of corporate governance. So here are the principles of corporate governance as laid down by the ASX, the Australian Stock Exchange. There are 8 of them. Here are the first 4. You can see that they're all focused at things that are okay and things that are not okay. We're trying to make sure that they don't happen. So solid foundations for management and oversight by the board. The role of the board is to represent the interests of the owners, and in that role, the board monitors or oversights the actions of management. Boards have to be structured so that they are able to do this and so that they add value. That is the definition of adding value, that they are able to implement proper corporate governance. Principle 3 says, promote ethical and responsible decision making. So we'll talk about what ethics are in business and what they might mean to you and me, but it is a requirement that businesses actually promote ethical and responsible decision making. So we can't slide away from that one. Principle 4 is to safeguard the integrity of the financial reporting, and that's Principle 5, make timely and balanced disclosure. Now, disclosure is something which particularly affects publicly listed companies, where in Australia particularly, there is a requirement for boards of publicly listed companies to disclose any information which comes to their attention which could affect the price of that business on the stock exchange. In other words, it's price-sensitive information. And if businesses neglect to do this, then there are very significant and severe penalties. Principle 6 is to respect the rights of shareholders. 7 is to recognise and manage risk. Now, recognising and managing risk is actually a very extensive process, and good boards will have risk committees. Sometimes those risk committees are coupled with the audit committee as well, and it is their job to try to imagine all of the possible risks which face a business, both large and small, and to ensure that appropriate mitigation is in place to make the impacts of those risks, should they occur, as small as possible. Principle 8 is to remunerate fairly and responsibly. So your reading list does give you the access to these corporate governance guidelines, and you should read the 8 principles, which are expanded and discussed in this document. They are extremely interesting and describe the requirements for good corporate governance very thoroughly. These principles are only necessary for ASX listed businesses. However, they're very good principles, and all businesses would do well to access them and understand that they are a gold standard of corporate governance for everyone. So briefly, the role of the board of directors. Well, boards of directors are there to represent the interests of shareholders. Primarily, they represent shareholders, and primarily they're there to oversight the actions of management to make sure that their actions are always taken in the best interests of shareholders. Of course, some boards can be good and some boards can be quite ordinary and quite bad. Some of the issues that we discuss when we're talking about what it is that makes a good board are the 5 that are listed here. These are the big ones. One thing that it's argued is terribly important for boards of directors is to have a majority of independent directors on the board. Now, independent in this context has got a precise meaning. It means that you're not employed by the business. It means that you were not employed recently by the business, and that usually means within the last 3 years. It means that you are not and have not been within the last 3 years a consultant to the business, and various other things which are put in place structurally to ensure that a majority of the directors on the board are independent. Now, the reason for this should be quite clear to you. Directors who are not independent may be tempted to make decisions which are more in the interests of management than they are in the interests of shareholders. The second point there, duality of the leadership role, refers to the CEO, the chief executive of the organisation, and duality is a term that refers to the CEO also being the chair of the board. Now, in Australia, that's a process which is frowned upon and has been frowned upon for many years. Until recently, it hasn't stopped businesses having that duality of leadership, and many small businesses, of course, will have that duality of leadership. But under the principles of corporate governance which apply to ASX companies, if that duality does exist, then the company is obliged to articulate what steps are in place to make sure that corporate governance is being effective and why it's okay for this particular business not to follow the recommendation of best practice. So we take that one very seriously. The size of the board is also a consideration. Large boards have difficulty making decisions. That's the same with any large group of people. The diversity of interests and the diversity of what they bring to the discussion becomes greater, and it becomes increasingly difficult to make decisions and to make decisions well and to make them promptly. It's generally thought that the size of the board, somewhere around 5 to 9, is probably the best range of choice. Qualifications of the board. It's now recognised that in order to be a board member, you have to have and be able to demonstrate that you know what you're doing. You must know about appropriate business practices and corporate governance. You should be qualified in related areas of the business. That doesn't mean that you have to have technical qualifications, although some people will, but it may mean that the board will have somebody with legal qualifications, somebody with financial qualifications, some people with technical qualifications, some people perhaps with social or community qualifications. Qualifications of the board are very, very important. Duration of appointment is another one that tends to go back to the question about whether you are independent as a director. It runs this way. If you've been on the board of directors for a long period of time, let's surmise here and say 10 years, 12, 15, 20 years, as used to be the practice in decades gone by, then it's difficult to argue that you retain your independence. Effective audit committees are another of the very, very important corporate governance mechanisms. Now, publicly listed companies must have audit committees as subcommittees of their board. Many other non-public companies do, as a matter of good practice, have an audit committee. The audit committee's role is to oversee the financial activities and the financial reporting of the business. Committee members on the audit committee must be independent. That's a requirement. If they're not independent, that's to say, for argument's sake, that they might be non-independent in the sense of being employed by the business. The ability to make unbiased criticism or comment about financial practices and financial reporting would be very deeply impaired. It's also important that at the very least the chair of the audit committee needs to be financially literate, and preferably all members on the audit committee should be financially literate. How is corporate governance enforced? Well, in Australia there is a legal process which goes under the name of CLERP 9. CLERP 9 stands for Corporate Law and Economic Reform Process, and it is in its 9th iteration. Some of the important rules under CLERP 9 for audits are listed below. The first is that audit committees of the board are compulsory for the top 500 companies listed on the ASX. The second is that auditor independence must be enforced. And so we ask, how do we observe that the auditors are independent of the board and of the management of the company? Well, there are some rules, and the first there is that the company doing the audit, that's to say the accounting company doing the audit partner in charge of that audit needs to be rotated at least every 5 years. Another important rule is that there is no cross-hiring between the audit firm and the business, where we have observed in the past where perhaps the former CEO of the business might be hired on the audit firm and vice versa. So these rules for limiting cross-hiring apply for a period of 3 years, and their goal is to make sure that the auditor is independent of management and independent of the board. Auditors are legally obliged to comply with these rules, as they are obliged to comply with all of the very many audit standards. So in summary, corporate governance refers to policy and procedures which are in place to make management decision-making accountable. Some of these mechanisms will be internal, some may be external, and a fine example of an external mechanism is the ASX Principles of corporate governance. Internal mechanisms include the board of directors and the subcommittee of the board, which is the audit committee. Keep in mind that the board of directors' role is to represent the interests of shareholders, and in doing that, of course, they must work closely with management. The audit committee, a subcommittee of the board, has as its purpose to oversee audit, the internal control and the risk management functions of the business.